Hello and welcome to our latest Insider interview. Today in the studio, I'm joined by Stephen Yu, who is fund manager of the Blue Whale Growth Fund. Stephen, great to have you back in the studio today.
My pleasure.
So Stephen, you've appeared in our Insider interview series a couple of times now over the years. But for those that are not familiar with the way in which you invest, could you summarise it?
Thanks for that. We run a high conviction global strategy. We typically invest into between 25 to 35 companies. We do all the research in-house. We don't speak to any sell-side analysts. We build financial model, and basically what we try to do is to find high quality businesses that are trading at an attractive valuation. And then ultimately we think we can pick more outperformers than underperformers, and if we do well, then you end up outperforming your peers and also the passive trackers.
When I last interviewed you on camera, which was around a year ago, you had exposure to 3 of the so-called Magnificent 7 stocks. You now only own 1, which is Nvidia, and you've since sold Microsoft and Facebook owner Meta Platforms. Could you explain why?
So the AI journey has been very interesting to us since 2023, when Nvidia surpassed $1 trillion in market cap. At the time, we were exposed not just to Nvidia, but at the same time, some software businesses and also data businesses. But I think the journey has evolved quite significantly over the last 18 months or so. And where we are today is we are very cautious on AI spenders, but we remain very constructive on companies or sectors that are on the receiving end of AI, any AI spending. So then if you think about Nvidia or Broadcom, they still very much remain capital light. At the same time, they're making a lot of free cash flow today, just because the margin is very high. But then when you look at the AI spenders such as Microsoft, Meta, Alphabet or Amazon, the free cash flow has deteriorated significantly. And at the same time, if you take a forward-looking view, which is our view, that we think the return on investor capital profile for some of these companies is going to be a lot lower than before the AI spending.
And given that you still own Nvidia, I'm assuming that you're comfortable with its valuation. The stock, of course, has had a very strong run over the past couple of years, and indeed over longer time periods than that.
Yeah, the valuation for Nvidia has actually gone a lot cheaper over the last 2 years. If you think about back in 2022, I mean, Nvidia is probably trading about 60 times earnings, and today is trading about 30 times earnings 1 year forward. And 30 times earnings would put Nvidia alongside Microsoft, Apple, MasterCard, or even like similar to Walmart. And so in a way that when you look at the earnings power or how much money that Nvidia is making today versus a few years ago has gone up a lot more than the share price increases. So despite the fact that Nvidia has gone up from $1 trillion business to about $4.5 trillion now, the earnings have actually gone up a lot more than that increase in share price.
And overall, how much exposure does the fund have to the artificial intelligence theme?
So we have about a quarter of the fund, I would say. Where we are today is we are very much positioned on the AI infrastructure side, so any company that on the receiving of any spending. And it is also our belief, which is remained the case today versus some years ago, that we do believe how AI is going to change the world, how AI is going to change how we operate individually and also professionally. And there's a lot more money that's going to be invested, and at the same time we're going to see many more applications that have just started to come alive, and that is going to sustain how AI is going to the AI cycle, or how AI is going to change the world.
So you've explained why Microsoft and Meta Platforms are no longer in the fund. In terms of your top 10 holdings, I noticed that Uber is now within them. Could you explain why you've been adding to that company?
So Uber has been quite interesting to us, very different to obviously your AI exposure. What we like about Uber, there are a few things that's happening within that. I'm sure most of our audience will be familiar with Uber, but 2 things that really strike us is, apart from the fact that they have dominated or consolidated the transport mobility space in terms of hiring a cab, but at the same time they're now expanding into a new TAM. If you go under Uber Eats, so not just to order your takeaways, but they have recently started to form partnerships with your grocery stores like Sainsbury, Waitrose, or John Lewis. At the same time, they're partnering with Currys, and in the US, they partner with different retailers. So suddenly nowadays, you don't need to go to your supermarkets to order your grocery anymore. You can go directly to Uber. And the benefit of doing that is you can get your delivery a lot quicker, or at least you can control it. If you order it now, you probably get it in the next half an hour rather than you have to book a delivery slot, which might be the next couple of days rather than instant. And at the same time, I think we are relatively positive in terms of how autonomous vehicles are going to be a contributors to Uber's business, because ultimately, if you look at autonomous vehicle is another option or alternative to a human operated taxi. Because Uber equally paid out about 70% of the income, and I think most of the big tech company would rather to have a partnership with Uber so that we still go through the Uber platform while the big tech company are going to operate the taxi in the back end. And everyone probably would have seen the news last week that Waymo is coming to London quite soon next year. So I think that's going to be quite interesting in terms of development.
When comparing your top 10 holdings today with a year ago, one company that's no longer in the top 10 is European defence firm Leonardo. It's had a strong share price run. Have you been taking profits as a result of that?
Yeah, so we have exposure to Leonardo, which is a European defense company. And we have done very well on the back of that. I mean, we started the journey back in 2023 on the back of the Ukraine crisis. But at the same time, I think what have really changed the narrative within the European defense space is on the back of Trump being elected. And we have a much larger position at the beginning of the year. And the share price has more than doubled in the last 9 months or so. So obviously, in terms of our investment process, in order to optimize the fund for better outperformance potential, I think you need to take valuation into account. And Leonardo valuation, I would say today is a lot less attractive than the beginning of the year. So we have taken a lot of profits. And at the moment, it's still a very small position. We still believe that the investment thesis will play out in terms of more spending is going into European defense, basically European Union being forced to do this. But how you translate your investment thesis into a company that can continue to do well, I think that is probably the how we are thinking about European defense at the moment. So we have taken a lot of profits as far as Leonardo is concerned.
And could you talk us through other portfolio activity? What have been the most recent buys for the fund?
So Uber was the one that you mentioned. And also recently we start to see some positive development within the luxury brand space. And within the luxury exposure, we have two companies. One is Moncler, the other one is Burberry. And of course, it could still be early days just because the macro environment have not improved significantly, but we could see that there's some potential that the valuation has bottomed out in a way that maybe now is the time to increase your exposure. So that's an area that we have been building our exposure to over the last couple of months. And I think at the same time, there's still within technology space, I think there's still some interesting names like maybe Lam Research. We've recently got into the memory or storage space. If you follow the AI development, obviously you need the GPU compute. At the same time, you need the AI data center. But I think thirdly, when you think about a lot of data that are being generated today, it's not going to be generated by humans, it's going to be generated by machines. So we're going to have more machine-generated data than the entire human population has ever done on record. So you would need to have more up-to-date technology in terms of storing those data that can be accessed quite quickly. So we think there's going to be a refresh cycle in terms of how the memory or storage is going to be done on data center.
One thing we didn't discuss a year ago, which has dominated the headlines so far in 2025, is US tariffs. Have you been making any changes to the fund in response to US tariffs?
So I would say that it's one of those things that we do take into account from a bottom-up perspective, because ultimately, while we invest into companies, so we consider ourselves as bottom-up stock picker, but what you need to also understand is every company operates in the real world. So every company operating in the real world would equally face certain headwinds or challenges that are being imposed by the tariff or by Trump's policy. And what you try to do as an active manager is to avoid companies that might be on the wrong side of the fence. So hence, when you think about European defense, I would say European defense probably would be one of the few net beneficiaries from Trump's policy, but equally there are many companies that are actually probably in the mix of the conversation. So what we did last year before Trump was about to be elected and also during the Liberation Day is you try to reassess how much of your companies or holdings are going to be impacted by the tariff. And I think the one thing that we did, not in a material manner, just because that is not new news. I mean, Trump was very vocal about his policy even before he was elected last year, so you can do a lot of prep work to avoid those sectors, is we also exited Nintendo this year. That while we have liked Nintendo for the last couple of years, we have done very well. We were very much anticipating a Nintendo to launch Switch 2, which they did, but we still think that there might be a bit of headwind just because the Nintendo Switch is going to be a lot more expensive than before. And in light of tariff, in light of consumer discretionary spending being squeezed from all fronts, would consumers be upgrading their Switch quite quickly this Christmas? So I think that's a question that we need to ask ourselves, even though the investment thesis in terms of the games that the IP they have on their games, like the Zelda, the Mario, the Pokemon, that's unchanged. Switch 2 is very beautiful, but it's just how much money they would be making versus expectation that is the question mark from our perspective.
Stephen, thank you for your time today.
Thank you.
So that's it for our latest Insider interview. Hope you've enjoyed it. We'd love to hear from you, and you can comment. And for more videos in our series, do hit the subscribe button. And if you enjoyed it, hit the like button. And hopefully, I'll see you again next time.